GM, good morning. Welcome to the Milk Road Show, the daily crypto show that's juicier than gossip at your high school reunion. I'm your host, Jay Hamilton, and today we're joined by Matthew Sigel, head of digital asset research at VanEck. Now, Matthew started his career as a journalist covering finance at Bloomberg and CNBC. He then went on to become a CFA, focused on tech stock analysis. He lived in Asia for 10 years. He fell in love with Bitcoin, just like the rest of us. And then in 2021, he joined VanEck. For those of you who don't know VanEck is a leading global asset management firm with over $100 billion assets under management. They're best known for their innovative investment solutions. They were one of the first to launch a gold mining stock fund back in the 60s. And of course, one of the first to launch a Bitcoin ETF earlier this year. Now, in today's episode, we're going to review VanEck's base, bear, and bull case for Solana by 2030. Now, this is based on a few key assumptions. First, they assume that Solana will be the first blockchain to host an application that has over 100 million users. They also assume that Solana will achieve a lower market share than ETH. However, we're actually going to talk about that specifically in this episode because based on the past 6 months, even 8-9 months, Matthew actually believes that will increase. And then finally, the VanEck team sees a path where revenues for Sol could be $7 billion that would flow to token holders by 2030. All of this led them to make price targets ranging from a bearish $10 per token price target for Sol up to a very bullish 3,200 price target for Sol. Now, all of this is anchored on market research and revenue estimations across key sectors, which Matthew will get into today. Before we jump in, everybody listening, we have an AMA tomorrow in the Milk Road Pro Discord. Yes, you do have to be a pro member in order to join. So if you're a pro member, make sure you join that. That's at 12 Eastern tomorrow, Wednesday, September 25th. If you're not a pro member, you might want to go pro and make sure you can get access to that AMA tomorrow because you can ask any questions. Investing is confusing. It's complex. Using on-chain investments is complex. Using your wallet can be complex, and seed phrases and all that, all these things, understanding where the market is going. What are they going to be the next catalysts? All these things are questions that you can ask, and it won't just be you. Even if you don't have any questions, there will be lots of attendees who have questions, which are going to be very similar to what you have. So make sure you join that if you're not already thinking about that. Also, we need to give a quick shout out to our friends over at Gemini. Discover Gemini, the US-based exchange built for new and advanced traders. As a special welcome gift, they are offering new customers $15 in Bitcoin just for trading. At Gemini, security is the top priority. As a licensed full reserve exchange and custodian, your assets are well protected. Plus, they offer cutting-edge security features like passkeys to keep your accounts safe. This exchange is setting the standard for compliance and innovation so you can trade with confidence. Head over to gemini.com/milkroad and start trading today to earn your $15 in Bitcoin. Sign up now and get ready to join the trading fun. Matthew, welcome to the show.
Great intro, Dre. Thank you.
Thanks. I appreciate that. It's always nice to get that credit early on. Okay, let's start with a first question here, which is back when you first wrote this model, you assumed that Solana would not flip Ethereum and would not achieve the lion's share of the market. Do you feel like that is an adjustment? And I should say you first wrote this in October 2023, so a year ago. How do you feel now, a year later?
Yeah, when we first wrote this piece, Solana was producing basically no fee revenue. So we used a lower market share target than we use for Ethereum, even though we have a kind of base case that this is a winner-take-all market and that like the dominant L1 will probably take 80% plus market share, but it just seemed too aggressive to put those in our numbers when we wrote the model. So we used 30%. The fees have obviously exploded since then. There have been days when Sol fees have flipped ETH, in fact. So if we kind of normalize that, it would take our base case price target from 300 up past 600. But these are all like very theoretical price targets with a lot of assumptions. And as you know, the asset class is extremely reflexive, such that, liquidity can beget liquidity. And unfortunately, the reverse can also happen, like we've seen time after time. So it might be worth just kind of laying the groundwork for why we were so attracted to Solana in the first place. And for me, that story goes back more than 15 years when I was working in equities and was a large holder of Qualcomm. Qualcomm, as you know, was kind of the dominant cell phone chipset maker. But what a lot of people don't know is that Qualcomm also had a mobile operating system called Brew. And there was a moment in time where the market thought that it might actually be Qualcomm that monetized users' location-based data and sold ads against it. And when you think about the history of the telecommunications market, like you had this one monopoly, AT&T, they had Bell Labs, which was supposed to be this great innovation engine. AT&T, because it was a government monopoly, the engineers at Bell Labs were not even allowed to write software. They literally were not allowed to write software. And so you had all these like world-leading engineers in the late 70s, early 80s who are realizing that the software stack is going to be incredibly important in how communications occur in the future. And they were getting bored and they started leaving and going to places like Renaissance Technologies, Goldman Sachs, basically, finance. And AT&T got broken up in 1984. What happened in 1985 is that Qualcomm was founded with strong ties to Bell Labs, and the algorithm that Qualcomm was built on, ended up revolutionizing cellular technologies, and that could have been, should have been something that AT&T invented. And I think that really highlights the innovator's dilemma that occurs even in network businesses with dominant market share. And so who else worked at Qualcomm was Anatoly, founder of Solana, who joined in 2003, who ended up working on that same mobile operating system, Brew. And what he encountered through those 15 years at Qualcomm was lawsuit after lawsuit. Qualcomm ended up getting sued for anti-competitive practices about its patent licensing business. And this Brew OS was buried inside of a company whose cash cow was elsewhere. And they were losing share inside of Verizon, inside KDDI. Who was taking that share? Google software, Apple software. So it took Toly, 2 coffees and a beer, famously, to come up with this idea. But I think the fundamental thesis that these heavily regulated businesses are not going to build the future of communication. They're not going to build the future of finance, the future of software, or frankly, the future of America. It takes, bored outsiders and a bit of regulatory luck to do that. And so when I encountered Solana and understood its DNA, and it has a fundamental difference from other layer ones in that they've really built the algorithm to take advantage of the hardware that will be in existence in 2 years, in 5 years. And it assumes that Moore's law continues, that networking costs come down, that speeds go up, and then challenges application developers to build on that kind of future-focused stack. And I think that's, really a culture of abundance, something that we should be encouraging. And if we're going to build a decentralized NASDAQ in which, even securities can be traded globally, maybe regulatory compliant, maybe not. We'll see how that shakes out. But you're going to need a blockchain with that ethos. So have been, involved in the token and the project for almost 4 years now, and very impressed with the progress that we've made. Sorry for that long intro, but I think it's important because you got to have some core beliefs in this space in order to have conviction and buy the downdrafts.
And I almost feel ashamed that we haven't told the founding story of Solana on this show before. So thank you for giving that to us, because it is very relevant to know where the founding team comes from. And also, we just recorded an episode yesterday where we talked about Solana Breakpoint, their biggest conference, which just happened. And I love that you made a point about the ethos and the culture that Solana has created, because it really comes through at Breakpoint, their biggest conference, because you have so many founders and developers on Solana that are taking big risks and they're trying things, and that very much aligns with the way Solana has created their chain and the way they have decided to focus their strengths. And I'd love to just chat about that. So what are the unique strengths of Solana as an L1 that attracted you to it?
Yeah. So I'd say that what we like about the chain, first, it's an excellent user experience most of the time. Transactions are fast. You've got finality in 2 to 3 seconds, and they're very cheap. We like that there is a vibrant research community, but it's led by practitioners, not wonks. So, many of the most important people in the Solana research community, they have practical experience creating things, and they tend to focus on things that improve the chain's functionality rather than more like esoteric economic ideas that get less play. And maybe that's because the inflation rate is higher. The focus on user experience, the clear purpose, which I described at the outset, which couldn't exist without a charismatic and brilliant leader, and then that commitment to kind of push the envelope today, and building where the puck is moving, not where it already is. And I think the emphasis on mobile with the phone and the Solana mobile stack will become increasingly relevant. We're seeing in Europe, both Apple and Google are going to face serious changes to their business model, especially in regards to the App Store. And that's, when we position these tokens to our clients, we're positioning them as open source app stores. So I think that we're kind of, it's ironic that the U.S. has antitrust suits against all of big tech and can't bring itself to embrace open source competition, but we think that'll change over time, or hopeful that it'll change over time. So that's what we love about it, about the chain. I think I don't want to be one-sided. There are things that need improvement. There is one of the features of our model with Solana is that much of the token value accrual comes from MEV, and so users are paying pretty high MEV taxes to trade in DeFi on Solana. There's definitely been spam issues and chain congestion. In March and April this year, some failure rates above 70%. The block explorers are just brutal. It's very challenging to track volumes and trading activity on chain. There's no equivalent to like DBank on Solana for tracking DeFi assets. The consensus design is very complex. So, there are few who really know how it works and therefore how it can be improved. And as Totally says, building an application is like chewing glass. It's difficult. You need high-level developers, and that limits the cohort of developers. Now, we think some of those things are changing, but I just want it to be balanced that there's good and bad parts to it.
Yeah, I appreciate that balanced approach. That's always the goal here on the Milk Road Show, is not to just give one-sided approach. One of the key factors with Solana is their data throughput that they enable. If I share my screen here quickly, I'm going to pull up your report, which shows a chart that'll be a little bit out of date now, but on a sense of scale, it paints the picture of the data throughput that we currently had, or at least we had back in 2023, but basically showing that if we have the data throughput of Ethereum and Polygon and Celestia and other chains, they don't compare to Solana today, let alone what will happen when Solana launches Fire Dancer sometime within the next year, sometime in 2025 is hopefully that will launch. Why is data throughput so important to creating a successful chain?
It just opens the surface area for what type of applications are interested in taking advantage of an open source permissionless environment. If your only goal is to store wealth outside of the control of central banks, and you're more interested in that like wealth preservation feature set, then you don't mind that the Bitcoin blocks are every 10 minutes. But if you want to turn over your assets, several times a week, several times a day, several times an hour, monetize little bits and pieces of your time, then you need something which is going to be much more high throughput and can handle the type of order flow that exists on a centralized exchange like a NASDAQ or on a payments network like Visa. So the more data throughput for the chain, the higher the potential for transactions per second, the more use cases that you can satisfy. And that comes with trade-offs. I mentioned that one of the downsides for Sol is how hard it is to use the block explorers, how difficult it is to gather like accurate data about the past state of the chain. And indeed, that may be one of the hurdles that's keeping regulators from approving a Solana ETF. I'm just theorizing here. There are hurdles, but the more data you can process, the more use cases you can attack.
And one of the key elements of your valuation was that Solana could become the first chain to have a killer app, quote unquote, something that reaches 100 million in users, which we have not yet seen on chain. And knock on wood, we'll see it soon, or sooner rather than later. Why is it so important that we have that killer app? And what would happen if we didn't have that killer app in Solana? What would that mean to the chain?
Yeah, so when we try to arrive at some price targets for these tokens, we try to segment the world into several different end markets and try to take a reasonable guess of what percent of the economic activity in those end markets is appropriate to be intermediated by open source solutions rather than closed proprietary databases. Roughly speaking, we identified 3 different end markets. The first is finance. That's a very broad industry, includes banking, includes payments, includes brokerage. The second is I'm still using the word metaverse, frankly. It incorporates social, gaming, advertising-based models. It imagines a world in which open source is taking share directly from these app stores of Apple and Google with more consumer-oriented applications. So that's category number 2. And then category number 3 is the infrastructure. So think of shared GPU resources, shared storage, shared networking. And in our base case, we're assuming that the open source solutions can get 5% of the market share for category number 1. That's finance. That's a very high touch business. Our estimates for metaverse are much higher, 20%. So we think that market's going to explode, and there's going to be, this may be some number of years out, but people will be interacting with each other and paying for goods and services, and advertising will occur also over those networks. So our estimates there are much higher, 20% penetration rate for open source. And then on the infrastructure side, we split the difference and call it 10%. So in the first bucket, the finance bucket, the tokens that are closest to money probably have the best shot. I would say Bitcoin is going to take a substantial amount of that market. But in the second bucket, especially peer-to-peer micropayments, entertainment-based, small ticket size, where you're talking about several dollars going back and forth, that's an environment where Solana may be most appropriate. That could even be stablecoins transactions, merchants paying for coffee, having a direct relationship with the merchant, earning loyalty rewards without paying 3% to your Visa or MasterCard, right? So it's really in that bucket where I think we could be kind of most optimistic that 100 million user app can and will exist. And given the throughput of the Solana chain, its memeability, that, Solana, the odds that Solana onboards such an app is probably as high as it is for ETH. So I guess that's the simple answer.
Mm-hmm. The other key factor that a lot of people like to talk about when we're valuing these change is the fee revenue. What is the fee revenue? How does it compare to the expenses of the chain? Obviously, in the case of Solana, their expenses are much higher than their fee revenue right now. That's not necessarily a problem now, but it could be in the problem of the future. How did you think about the revenue versus expenses of Solana now versus long term?
Yeah. Well, if you look at the yield for stakers, it's at times this year has exceeded the inflation rate. So that is a very unusual and bullish, positive, I think, dynamic for blockchains. It's basically ETH and Sol that have had that characteristic, and that implies that the chain is sustainable, that there's enough economic activity, that the fees paid by users plus the MEV extracted by market makers is covering the cost of issuance. So in our models, that the economic value that's created for Solana, the majority of it is from MEV. As you know, it's quite expensive to run Solana infrastructure, and that entitles the validator to extract additional profits from arbitraging some of the activity that occurs across the chain. And the number of entities that are capturing those economics in Solana is probably fewer than it is in Ethereum. And as a result, the MEV is a much higher percentage of our model for Sol than it is for ETH, like more than 2x. 70% of the value of our Solana DCF is coming from the MEV that's created and then returned to token holders. For ETH, it's much lower, less than half of that.
So if we take a look at your price predictions for Solana by 2023. Now I realize that you created
2030.
these. Sorry, 2030. Did I say 2023?
I wish.
That would be nice. If we take a look at this, you have a value per token on the base case of 335, bear of $10, and bull of 3,200. Now, obviously, there's a wide range here. And you said at the beginning of the show that based upon the last year of chain activity, that you might actually increase the base case to maybe double or 2.5 times that. I don't want to necessarily focus on these specific numbers because, as you said, these are assumptions with a lot baked into them. What I would love to talk about is what are the catalysts that would get Solana to these numbers? What are the things that maybe are the risks that might hold it back?
Sure. Yeah. And let me just caveat that like these price targets are, not financial advice, not investment advice. I still think it's, very early in this space, and we're essentially in a portfolio, liquid token portfolio. We're holding a collection of call options on a different financial future, and then we're using these price targets to help inform our position sizing, and it forces us to write down a set of kind of key performance indicators, KPIs, that we would then track in order to figure out is reality tracking alongside our estimates. So that $300 estimate for Solana was based on those kind of end market penetration rates that I described: 5% of finance, 20% of kind of metaverse, social, gaming, advertising, 10% of infrastructure. It assumes that Solana terminal market share would be 30%. That would produce roughly $8 billion in revenues. We tax that by 15% taxes, 1% to the validators, and you basically end up with a free cash flow to token holders of roughly $7 billion. And we apply a 33 times multiple to that, 33 times cash flow. So that's roughly a 3% free cash flow yield. You can debate that, plug in your own number if you think more or less. That earnings multiple, in my view, is equivalent to the moneyness of the token, essentially, and that gets you to $334 per token by 2030.
So, looking at the market now, looking at where things are, let me actually ask a quick question.
Yeah, so like to answer your question, when we first put this out, there was de minimis fees on Solana. By March, Sol was flipping ETH some days on revenues. So, if I were to refresh this model, I'd probably bump the 30% market share up to 60 or 70, which is comparable to our estimates for Ethereum, and that would be a base case of 600 something.
What do you think the landscape of L1s will be long term? You mentioned this, you've already sort of teased your thoughts on this a little bit, but I'd love to hear how you break down L1s. Will there be one dominant player, 5 dominant players?
Really your guess is as good as mine, and it's very dynamic. But having covered the big tech stocks starting in 2007, you could really feel the winner-take-all characteristics in the space, the advantages to scale, the regulatory capture that inevitably occurs. It seems most prudent to assume that one smart contract platform ends up with 70 to 80% market share, that it's too early to know exactly who that is for sure. So try to figure out what they could be worth at that 70, 80% market share, and then position size according to the progress made towards that milestone. So practically speaking, what that means for me is that my Solana position has grown to be bigger than ETH position on performance alone. And I'm more in the camp of don't just do something, sit there. When something happens, I think people make more mistakes by trading than value they add by trading. And it's better to assume that the market is right if you have a long-term thesis, and don't try to do too much. So that's why
it's great advice.
My Sol position's bigger than my ETH position, just from the inertia of letting it run.
Right. It's amazing how the best thing that most investors can do is to just do nothing and continue to DCA in and maybe DCA out and take some profits and have a plan. I mean, one of the best things that most of our listeners should do, and we've talked about this all the time, and you can go back last week with an episode with Zeneca where we talked about exactly what you said, of actually writing down some price targets and having some KPIs for how you think about each one of these things. And look, everybody doesn't have the team that you have or the capabilities that you have at VanEck, but everybody can think critically themselves. And just that exercise can help you have a lot of conviction in your investments. I want to touch on the Sol ETF that you guys applied for in June, I believe, was when you applied for that. Correct me if I'm wrong. And based upon your application, the way I understand it is you would get a decision sometime in Q1 2025. Any update on your application for the Sol ETF? What do you think the likelihood of this would be, and what made you guys apply for it?
I'll take the last one first because that's the easiest. What made us apply for it is that we have high conviction that Sol is one of a very small handful of L1s that could end up with 80% market share and be money. Generally speaking, the SEC stance on digital assets has not changed since VP Harris took over the candidacy for president. And as a result, listeners should not expect any Solana ETF until the administration changes. Our application is not currently live, so there is no deadline for the SEC to make a decision. Stay tuned for an update on our end to move that forward.
Okay. I did not realize that it was not currently live. Thanks for clarifying that for us. So we'll keep everybody updated. We'll watch out for the news, and we'll make sure we talk about it on the show when we get there. Closing thoughts before we wrap up here, Matthew. What should investors be looking out for in this market right now? What are you keeping your eye on, particularly with regards to the majors, since you know that is what most of our listeners are invested in?
Yeah. So I still think Bitcoin's the tail that wags this whole ecosystem. Very focused on sovereign adoption of Bitcoin. We've noticed this year that the number of countries mining Bitcoin with support from the central government has grown from 4 countries to 7 countries. And frankly, I'm looking for that to accelerate further and for bigger countries to announce Bitcoin mining endeavors. I think if Kamala Harris is elected, that could happen sooner rather than later, with Bitcoin dominance potentially continuing to rise. Whereas if Trump is elected, I think it'll be more broad-based, altcoin rally and just general market cap growth across the space. VanEck now has our own stablecoin that we're backing. It's called Agora US dollar. So that is Jan VanEck's son Nick, who's launching that project. It's on Ethereum, Avalanche, Sui, a number of different networks. We think we can gain a significant share from Circle and Tether by being more aggressive about sharing revenues with our distributor partners, the market makers, the exchanges. So super optimistic about stablecoins. Think it's going to be very fragmented for a number of years, but that has the potential to drive not only change in how merchants interact with their customers, but also drive the price of Ethereum, Solana, and other open source assets higher to the extent that these stablecoins proliferate. So excited to be driving that.
Since you brought up Agora, we haven't actually talked about this on the show in depth yet. Can you explain how Agora is sharing yield briefly with the distributors? It's a little bit of, we haven't seen a stable coin take this model yet.
Well, you kind of have, in the sense that Circle did a rev share with Coinbase, right? Because Coinbase owned a piece of it. So you can do it. It's a bilateral negotiation, right? What you can't do is just share the yield with your retail customer, because the government thinks that's a security, but you can negotiate bilateral deals with your distributors. So that's how that'll be done. Recommend you get Nick on next.
Okay, well, I'll have to get him on next to chat about that. Matthew, thank you so much for your time today. Everybody listening in, if you don't already follow Matthew on Twitter, make sure you do. We'll throw the link to his Twitter in our show notes. And also, we'll keep you guys up to date on all VanEck reports. We're always talking about VanEck in our Milk Road newsletter, so make sure you subscribe to our newsletter, or you might want to go over and check out VanEck as well, because they're producing so many things. Matthew, any final thoughts to share with our audience today?
I'm good, Jay. Thanks for the time.
Keep hodling, right? Matthew's got his hodl hat on, so make sure you guys are hodling as well. Appreciate your time today. Everybody, thanks so much for listening in. Have a wicked awesome day. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note. This show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.